All right, let's just jump right into this explainer. Today, we're putting Graham Holdings Company, ticker GHC, through a really rigorous financial health check. Finding a company trading below its intrinsic value is basically the holy grail of investing. But to find those hidden gems, we've got to look past the superficial numbers and dig into the real structural data. Let's take a magnifying glass to GHC. Wow, right? Currently trading at a hefty $1,093 a share, GHC's stock price instantly demands our attention. It's exactly the kind of sticker shock that makes a lot of retail investors immediately pause. When you see a four-figure stock price, it is completely natural to wonder, hey, have I already missed the boat here? Or maybe you assume the market has already priced in all of the company's future growth to an absolute premium. So, with a price tag that high, the ultimate question we have to answer today is whether the underlying financials actually justify the cost. A massive share price does not automatically mean a company is overvalued, just like a penny stock isn't necessarily cheap, right? We have to separate the sheer size of the share price from the actual valuation of the underlying business. To get to the bottom of this, here's our roadmap for today. 1. Decoding GHC's valuation. 2. Peeking under the hood at its financial health. 3. Examining cash flow and dividends. And 4. Calculating that all-important fair value verdict. Section 1. Decoding GHC's valuation, checking the price tag. Let's see how that massive share price actually stacks up against its own historical baselines. Okay, look at these multiples. What really jumps out here is the price-to-earnings ratio of 16.18. That's actually sitting almost 17% lower than its 5-year average. It's kind of crazy, but it suggests it might be cheaper now than it has been historically. On top of that, we're looking at a price-to-sales ratio of 0.94 and a price-to-book ratio of 0.99. You're basically paying less than $1 for every dollar of sales the company generates, and you're buying it right at its book value. So why does this matter? Well, while a PE of 16 isn't exactly dirt cheap in a vacuum, context is everything. Compared to its own recent past, the market is giving us a relative discount on GHC's earnings. This suggests that right now, the markets is either feeling pretty pessimistic about GHC's immediate future, or they've just kind of forgotten about it, which creates a potential pricing inefficiency for us to explore. Moving right along to Section 2, under the hood, financial health, checking the engine. Because hey, a cheap stock is just a value trap if the underlying business is broken. Let's look at their operational efficiency to see if they can weather economic storms. Check this out. A debt-to-equity ratio of just 0.17. I mean, in a market where everyone seems levered to the gills, a number this low is honestly a breath of fresh air. It tells us they rely very little on borrowed money, which drastically reduces their overall financial risk. It means the company is primarily funded by its own equity, giving management incredible flexibility. And the liquidity is just fortress level. With a current ratio of 1.79 and a quick ratio of 1.54, both of which are significantly beating their 3 to 5 year averages, by the way, they have tons of short-term liquidity. Literally, if every single short-term creditor knocked on their door today, GHC could pay them off without breaking a sweat, relying strictly on their most liquid assets. But yeah, it's not all sunshine and rainbows. Look right here at the return on equity. It's dropped to 6.25%. That is a massive 49% plunge compared to its trailing 12-month average. This is a metric we cannot ignore. A dropping ROE tells us that recently, the company has become way less efficient at generating profit from the shareholders' equity. Actually, this is probably exactly why the market has discounted its PE ratio. Which brings us to this absolutely fascinating tension in the data. Over the last 3 years, earnings per share has shrunk by over 15%. Wall Street obsessively watches EPS, so that explains the discounted valuation. But look at free cash flow. It has grown at an annualized rate of almost 34% over that same 3-year period. As we all know, earnings can be manipulated by accounting quirks, but free cash flow, that is cold, hard cash. And that cash engine is absolutely roaring. Which segues perfectly into Section 3, cash flow and dividends, paying the owners. A company generating over 33% annualized growth in free cash flow has to be doing something with all that money, right? Let's see how they reward shareholders. So, GHC pays a modest dividend yield of 0.69%. I know. If you are a hardcore income investor, you're probably rolling your eyes and ready to scroll past. But hang on a second. Looking at a single number in isolation rarely tells the whole story. Look at the underlying fundamentals here. They've bumped up this dividend for 9 consecutive years. And they're paying out less than 11% of their earnings. Better yet, look at the free cash flow yield. It's sitting comfortably at over 6%. This means that dividend isn't just safe, it's practically bulletproof, with massive room to grow. They could literally double it tomorrow and be totally fine. And when you zoom out, you really see the compounding magic over the decades. Reinvest those dividends, add in steady price appreciation, and look at these returns, almost 74% over 5 years. Stretch that out to 20 years, you're looking at more than 234%. It just proves the quiet, steady power of a financially conservative cash cow over the long haul. All right, section 4, the fair value verdict. Putting it all together, now that we've seen the health and the cash flow, let's look at the ultimate metric, intrinsic value. We're using a discounted cash flow model here, taking all that future cash they are projected to generate and discounting it back to today's dollars to see what the stock is actually worth right now. Before I drop the final numbers on you, let's quickly touch on margin of safety. Basically, this is your buffer. It's the percentage discount you get when buying a stock below its actual calculated worth. It is arguably the most important concept in value investing because it protects you from the unknown, whether that's a market crash or just a slight miscalculation in our own DCF models. So, the moment of truth. Let's see how this builds our final conclusion. Based on the DCF metrics in our data, GHC has a calculated fair value of $1,269.44. Compare that to its current trading price of $1,093. The raw cash flow data is essentially screaming that the market is distinctly underpricing this asset right now. Do the math, and that translates to a margin of safety of exactly 13.90%. You are effectively buying $1 worth of business for about 86 cents. In today's market, which often feels incredibly overextended, finding a company with a proven track record, a fortress balance sheet, and a near 14% discount to its cash flow value, that absolutely deserves a spot on your watch list. To summarize our explainer today, GHC is this fascinating paradox. On one hand, you have a highly liquid, low-debt company generating massive free cash flow, giving us a roughly 14% discount to fair value. But on the flip side, we've got those glaring headwinds, those recent dips in ROE and EPS. The market isn't blind. It is definitely pricing in those drops in efficiency, which is exactly why this discount exists. Which leaves us with a critical question to chew on for your own analysis. With a 13.9% margin of safety on a low-debt cash machine, does that recent drop in profitability scare you away? Or are we looking at a rare textbook buying opportunity? Does the pristine balance sheet outweigh the recent inefficiency? Run these numbers through your own strategy and let the data guide you.